Welcome to Inside the Deal. I'm Suzanne Stevens. My guest today is Dino Mauricio. Dino manages the M&A integration practice for Getzler Henrich Associates and is also a former managing director for M&A at GE Commercial Finance. Dino, you and I spoke recently about post-merger integration in financial services. There's going to be an avalanche of integration issues that these banks that are coming together are going to face. But what's really different this time than in a normal environment is the pace at which these deals are getting done. There hasn't been a lot of groundwork laid. So how does that change the approach to integration that these entities face?
Good question. The continued restructuring of the financial services industry, we've seen a rash of big deals announced. A lot of them are shotgun marriages where these buyers and sellers really have little time to prepare for integration planning, and therefore they need a fresh approach to how they're going to deal with very difficult integration related issues. Examples are the JP Morgan and WaMu deal, as well as the Bank of America and Merrill Lynch deals. I think both of those deals create some very high stakes in terms of making sure those integration processes work.
Well, I guess the upshot of it is that when the alternative is bankruptcy or collapse, both parties are usually motivated to get the deal done.
Absolutely. Both the buyers and sellers are looking to create a better post-merger organization and banking company after these acquisitions and mergers are complete. Not only that, I think the entire financial services system is looking at these mergers and hoping for their success, and that will pave the way for additional I think mergers in the industry as we have additional failures and disruptions throughout the industry. I think what makes it very difficult for them, however, is that after decades of consolidation, this is a very difficult climate. The cost basis for these banks are much leaner than they were in during the late 90s when the last wave of consolidation occurred, and therefore the low-hanging fruit in terms of cost savings may not be there. On the second point is that these shareholders and the buyers of these companies are looking more for than just cost savings. They need to think about much more the customer experience and what happens to employees. So there's a lot of importance being driven toward the softer side of integration, which can pay a lot of dividends down the road if done correctly.
Well, speaking of dividends and the financial return on these integrations, does the climate that these deals are getting done in, does that buy some time for Bank of America's Ken Lewis and JP Morgan's Jamie Dimon to get these integrations right?
You'd like to think so. I mean, and the more time they'll have to really assess and evaluate integration issues, the better for both companies. Unfortunately, we're in some very uncertain and difficult times, and I don't think there's as much patience, or at least as much time as they would like to really go through and make all those decisions. I think both JP Morgan and Bank of America have announced plans with very sizable synergy targets and a 2-year time frame for getting all these things done. But we all know that these deals are really driven by immediate needs for liquidity and confidence in terms of the banking system. So I think I would suggest the 100-day plan really creates that balance between immediate needs and long-term goals for these mergers.
So, Dino, it's unrealistic, I think, in this climate for investors to expect a financial return in the short term, but what can they be looking for in the near term in the Bank of America deal and the JP Morgan deal?
I think shareholders can deserve and expect very tangible results to these integrations early on. You notice their stock prices did get a lift during the announcement of these deals because there is a high bar or a high expectation of benefits, both in terms of geographical and product expansion, as well as just putting together two very strong franchises. Unfortunately, these shareholders are also very fickle, and they can move their money at a moment's notice. So they're going to have to be proven by these banks that they are developing some long-term value with these relationships, and not just taking a good assessment of the financial assets, the asset quality, and so forth, but more toward the people and softer side of integration, which means the maintaining and organizing the talented employees, maintaining those strong customer relationships so they can not only build upon that base but also attract new customers, and finally the cultural differences, really taking hold and understanding what challenges are between two very different cultures in both mergers that could certainly be hurdles for a successful integration.
Dino Mauricio, thanks for stopping by.
You're very welcome. Thank you.
I'm Suzanne Stevens, and be sure to check out our story in the October 13th issue of The Deal on post-merger integration and financial services. Thanks for watching.